Gautam, I was just looking at the screen and thinking in my head that what a long way we've come off from the March lows, right?
Yeah.
What do you think is working and what do you think is still left to be conquered?
So, Aisha, thanks for having me here. There are 2 or 3 things which are helping the markets. I think some moderation in the geopolitical hostilities, which has brought the crude down to manageable levels now. Second, I think the fatigue in the global AI trade, which had like everyone talking only about Korea and Taiwan. Wherever I have done recent global roadshows in Hong Kong, Singapore, even Europe, people were just on and on about Korea and Taiwan, and India had become like a bit of a pariah, right? So, I mean, it's good that we are also making a comeback to an extent. But the most important thing, Aisha, which is helping at the margin is the corporate earnings. The corporate earnings season is turning out far, far better than expectations. Not just the aggregates, but even the spread of the earnings, the number of sectors, the beat to miss ratio. First time we are seeing an earnings upgrade after a very long time. And then, of course, the high frequency data points that you've seen, the auto monthly, which has come in yesterday, GST data, credit growth is almost in the 19% handle. So whatever actions the government has taken over the last 9 months, I think the reduction in income tax rate, the GST cuts, the interest rate cuts that we have seen, cumulatively, all of that is helping at the margin. And this is happening despite the monsoon still being, 15-16% deficit. And last but not the least, the last 2 years of consolidation / time correction, especially in the benchmark indices, has also made valuation a little more palatable versus where we were at 23, 24 times in September 24. Today at Nifty, we are at about 18.8 to 19.1. And EPS is holding on at about 14-15% growth. So if this earnings continues like this and expectations remain intact for September, October, I think there is more upside to be had. We have to be far more constructive on market today, purely because the underlying earnings are looking very, very strong.
So I want to pick up on your SWOT analysis one by one, and let's first talk about earnings. Because they've grown about 2% on a year-on-year basis. You were anticipating a dip of about almost 10%.
Yeah.
Would you say this is a genuine beat, or would you say this is largely an OMC-driven beat?
So I'll look at numbers. Let's for the discussion keep OMCs out. Okay, if you keep OMCs out for the 211 companies which have declared numbers till Sunday, you take 3 out, which is 208. For them, we were expecting 13% earnings growth. The actual earnings are 17%. Similarly, for mid-caps, if you exclude HPCL, the earnings is about 25% higher, which is like a big number, 25% higher earnings this year, this quarter. Now you go back to small caps, about 90 small caps in our coverage of declared numbers. For them, the earnings are up close to 32%, right? Now, this is a quarter. If you look at on an annual basis, last 2 years, Nifty has done absolutely nothing. FY24 EPS was 1,000 rupees, FY26 was 1,065. So cumulatively, you got 6% earnings growth in 2 years. And market also gave you 5% return. The March 2024 Nifty market cap was 181 lakh crore. March 26 was 192 lakh crore. So whatever earnings growth you got, the equivalent market returns you got. But in this 2-year period, for example, in FY26, if you just look at the latest year, Nifty earnings were of 5%. And that was the story that India mein earnings growth nahi hai. But if you looked at Nifty 500, earnings grew 15%. My coverage universe of 380 stocks had delivered 15% earnings growth in FY26. More importantly, within that, the mid-caps, and we cover fairly large number of mid-caps, almost 105 out of 150. So for those 105 mid-caps, the earnings growth was 24% last year. The only sour point for last 3 years was small-cap earnings, which have compounded just at about 10%. So what was 63,000 crores of earnings for small caps in our coverage for 180 companies? In FY23, it ended at 83,000 crores. So 10% CAGR on a 3-year basis. Now, on that base, next 2 years, we are expecting 30% growth. So far, the first quarter, we have not seen any earnings cut. In fact, we have seen a marginal upgrade. So for my entire coverage universe, we have seen about 1.8% earnings upgrade for FY27. That sounds like music to the ears. Second, the number of companies beating estimates and meeting expectations cumulatively are 78% of the coverage universe. So only about 22% of the earnings companies have disappointed or have missed the expectations. Number of companies where earnings have been upgraded divided by number of companies where earnings have been cut is 1.7 times. This ratio was below 1 for a very long period of time. So early signs of an earnings revival. And more importantly and hearteningly, your top line growth is in a handle of 17-18%, which is highest since December 2022. So a bit of an inflation making a comeback is also helping, because last 2 years, your nominal GDP was 8.5, 8.9%. This year, we are expecting about 13% nominal GDP growth. So 14-15% earnings growth for benchmark indices looks doable for next 2 years, but the real fun is outside Nifty.